Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah. Our guest today is Krishna Kumar Karwa of Emkay. Krishna, great having you. Thanks for taking the time out.
Good morning and thank you for inviting. It's always a pleasure talking to you.
Likewise, the feeling is entirely mutual and the pleasure is entirely ours. Let's think about whether equity investors can have a pleasurable next few days, weeks, months in light of the fact that we've almost nudged 20K. The run up has been sharp and the result season, you could argue at best, has been mixed.
If you look at from the last 3 to 4 months, from 1st April, maybe what, 17-18% kind of an uptick in the large cap indices and maybe slightly more in the small mid cap indices. So phenomenal run. It built up on basically disbelief. Nobody believed the initial part, but it just kept on rising. So yes, no doubt that there is a feeling of left out among many investors. So maybe the corrections may not be sharp. But having said that, individual stocks or sectors, if you look at in a large cap, if you look at IT still is disappointing, or rather it's work in progress. Stock prices have not yet corrected to attractive levels. It's the banks, NBFCs that have given very good performance, and hopefully in the coming quarter also they should do well. In the large cap indices, it looks like that except for the banks, there are not too many heavyweights who can pull the indices up further. So, and even in small mid cap, yes, there are pockets of positive surprises as far as numbers are concerned, but then it is also getting discounted very aggressively. So, temporarily, it looks like that we are getting into a phase of consolidation. And I think the whole China, the flows which happened after disappointment with China, that part also seems to have played out. Oil again seems to be strengthening. I think you have your Fed rate hike this week, which possibly is discounted. Net, I think a period of consolidation before we move to the next level. But I'm not talking of any sharp correction, maybe a period of consolidation and some stocks which have not delivered to the potential, or where the improvement in earnings could be more back-ended, maybe those stocks will give opportunities for long-term investors to invest in.
The constructive argument that I hear from people who are constructive are saying that the index, as you said, might consolidate. We are probably at a standard deviation or slightly more than that on the index level. But a clutch of names, again, as you mentioned, are not quite there. Banks, for example, post the correction, maybe IT, not that IT is constructive, but it is certainly off from the highs that it used to trade at, and a few others. So the argument is that the bull argument is that the index may stay at the current levels, maybe slightly lower, but a lot of stocks can be pulled up to those +1 standard deviation levels because the flow of money, both from global and local, still seems to be strong.
Definitely, I agree with you. I think India has always been a bottoms-up market, and that's what active fund management is all about, which is buying into stocks which are relatively attractively valued. I think whether it's a bull market or a bear market, there are always opportunities to buy and sell. So I don't deny the fact that there will be opportunities to invest in. So I think that's where smart active fund management comes into play, where wherever there are corrections which could possibly be maybe temporary, or where the valuations become attractive, I think investors should be looking to invest into them. And some of the sectors which for various reasons have not done well in the last few years, or rather last 1 year, where valuations have become attractive, maybe that could be the places where you can park additional funds. Like last time when I met you, or rather we had an interview, I spoke about the whole insurance and wealth management and broking and that kind of space. And yes, I think the opportunities came, and decent returns have been made by investing in those kind of companies. Today, I feel that maybe some of the spec chem companies, some of the agrochem companies, and they have disappointed in the last 2-3 quarters. But are we possibly near the end of the cycle? Maybe a few more quarters, and it should be. So wherever valuations are attractive, the core value of the business needs to be assessed and not the short-term headwinds. Markets are giving you opportunities to invest in those kind of opportunities from a slightly medium-term perspective. Maybe the momentum is not there, but valuations in some of those companies seems to be becoming attractive.
Yeah, this conversation about the capital markets we had around the Independence Day last year, which is when we last met Mr. Krishna Kumar Karwa in person. From there, you have to argue that some of those or most of those names have actually done well. So, yeah, credit where it's due. Spectrum is an interesting one. Just a counter there before we and you know what I'll do is, since we've entered sectors, we'll kind of finish this conversation. Then I have a couple of
Sure.
questions around the central banking meetings lined up for the rest of the week as well. But since we've dwelt into sectors, like a follow up on SpecChem, the commentary thus far from all the global majors that have come out has been, well, not just not constructive, it's actually been a bit pessimistic. When they are saying that they have not seen the expected pickup, they believe the next 6 months also they don't see anything. Now, I heard you say that a few more quarters of pain there might be. My question is, are the valuations already low enough for the pain of the subsequent quarters to not impact the prices further?
I think that's where your skill set as a bottom of stock picker comes in. So I'm not saying the sector as a whole probably gives you many opportunities,
Okay.
but some of the leaders in the spectrum segment, who have the track record of last 15, 20 years, who have the size, etc., and where valuations seem to have become attractive. And sometimes there are some concentrated holdings being offloaded by disappointed investors. So that gives you an opportunity to invest in, and not and knowing fully well that for a few quarters maybe we'll not yet get the pickup. But then sometimes just look at the valuations and believe in the management capabilities, and that's what contra investing is all about management capabilities, valuations being attractive, and taking a contra bet from a slightly medium term perspective. And many of these companies are not exactly large cap. They would be in the mid to mid large cap. So even liquidity, etc. This is the time when you can build large positions and be ready to keep on averaging or adding on your positions as time goes by.
Okay. Um, Thanks for that. The pocket almost in the same line as SpecChem, and which has actually done well in line with the Nifty since March, is pharmaceuticals. The recency bias also seems to be strong. It's a packed next 2 weeks with pharma earnings. Has the space bottomed out, you reckon?
Yes, in fact, I should have mentioned that in this thing. So maybe also that was again a contra bet, contra investing, which some of these companies have the stock prices have done well. The commentaries coming from many of these companies regarding the excess inventory in the system, the challenges that they had on supply chain or input prices, etc., all being behind them, and markets have also reacted positively. I believe that the commentaries which will come from many of these companies will be more constructive, and investors have anticipated that. But I also believe that pharma plus CRAM, many of the companies who are in the CRAM space over there, I think from a medium-term perspective, they offer a very good opportunity to invest in. And as far as some of the companies who have evolved into specialty pharma, etc., I think they have their own space. But some of the CRAM companies, I think they have gone through a tough time in the last 12 months. I think they should definitely make a very good comeback in the opportunity to invest in some of the pharma companies who are global facing is obviously there. Local domestic pharma companies, they continue to do well, and it's a very steady business. And I believe that there is a decent opportunity to invest in some of those companies also.
The other most obvious question would be banks. Now, relative to their own historical multiples, at least the largest bank trades at a discount to that. But the commentary that I read over the weekend, both from Kotak and ICICI Bank, is yes of growth, but of compression in NIMS, further compression in NIMS from what happened in Q1 as well, which saw a slight compression. So now my question is, would markets reward credit growth and take the valuations up a notch, or will it be a factor of just the kind of NI growth or ROE growth that these banks will deliver over the next 4 quarters that could determine the fortunes? What do you think?
The way to look at it is that is this the best number that they can devote in terms of, and they can deliver in terms of credit costs, in terms of names, etc. From here, will it, whether it takes 2 quarters, whether it takes 4 quarters, who knows? But there has to be deterioration only. That's a call that one needs to take from a medium-term perspective. So my sense is that going forward, many of these large names which are fully discounted, they will become kind of compounders because the systems and are very robust for credit. I mean, so the earning growth would be very stable, earning growth, credit growth, etc., depending on the state of the economy. So they will become compounders rather than investors to hope that the valuation multiple which the market has given to them, whether there will be any expansion in the valuation multiple. So many of these banks now are in a position to steadily grow between 50 to 20% on a PAT basis. And accordingly, the book value will get added. My sense is that can they deliver those kind of returns over the next 2, 3, 4 years? Definitely yes, because the systems that have been put in place by almost everybody in the ecosystem, also by the regulators. So there will be a nuanced increase in credit costs, etc. There will not be any surprises in terms of disclosures. So all those things are into play. So yes, can you make big money in terms of multi-baggers? No. But can you make decent money? Yes. Over ownership also becomes a concern. So you will have these phases where despite the best of performances, the stock prices may not exactly behave in the same fashion. So you will have this kind of starts and then stops in terms of the stock prices also.
Okay. One last sectoral question before I move back to macro, and that is,
Sorry, before that, I think let me just add is that there are opportunities in terms of valuation re-rating, which could possibly happen in many of the public sector banks. I think they have also got their act together. The numbers seem to be all decent. Their ability to mobilize deposits, that's going to be a key differentiating factor. If they're able to do that, then investors will, and there are a reasonable amount of under ownership also in the public sector banks. So my take is that investors looking for more than earning growth capture in the stock price, then some of the public sector banks could be an opportunity to invest in rather than well discovered, well known large cap private banks.
okay, okay, point well taken. Uh, just a word on the commodity plays, if you will. I mean, just overnight, Tokyo Steel came out with this just fantastic set of numbers. They upped the guidance. It related and resulted in a bunch of other global steel names doing well. The commentary from JSW Steel, they just came on air at 9:30 before we started talking to you, was constructive both for Q2 and the next half as well. We are waiting Tata Steel today, of course. What's your sense on ferrous and non-ferrous within India?
So honestly, I will not be able to help you too much on this because I don't track it so well because we are global cyclical at the end of the day. I'm not tracking it so well, so I should not be able to.
Let's skip it. Okay, maybe you have a thought, and that was my final sectoral question, really,
Yeah.
on the bit of disbelief, maybe rightly so, maybe wrongly so, on this kind of moves that have happened in or are happening in some of the B2G spaces now, whether it's the PSU defense names and a Mazgondorf or a HAL or some of the others are going through the roof. We've seen the railway stocks do really well, and today there was this report about how another order for 25,000 wagons might be on its way. Some of these things in sectors which have been existing for the last 15 years are so rapid, it's almost difficult to wrap your heads around, especially if you've seen these sectors suffering for the last 14 years. So how do you think about these?
No doubt about the opportunity. I think the many of these companies have been through tough times in the last 5, 10 years, as you said, and now they are seeing the benefits of all that in terms of the huge amount of order inflows that all these companies are witnessing. Yes, it is always a challenge when you have one big customer, which is the government of India or the state governments, I think, in terms of some policy changes or in terms of cash flows, etc. We have seen earlier, so that you need to be taking cognizance of that. So to that extent, one valuation multiples that you give to these businesses should be taking that into consideration. Many of the stocks in the sector, whether they are railway facing or whether they are the defense facing, they have been multi-bagger in the last 2.5 years. I think some of them have been like 10 baggers, etc. So I think investors just need to be careful, cognizant about one is the execution capabilities, because order book is one part of it, but at the end of the day, it's all about how profitably you are able to execute those orders. I think that is something which is very today we are just giving a run to the stock prices just based on order inflow. I think so. Execution capabilities also needs to be carefully looked into, and then the absolute valuation. I think so. Whenever there is a frenzy, I think it's best to stay away and wait for a decent correction, wait for some market disappointments, maybe sometimes macro, sometimes micro, before you get into these kind of frenzy stocks. So opportunity, yes. Would I buy into any of them at current prices? Possibly no.
Okay. Okay. Point well taken. After a lull for the last 2 weeks, we have a very busy week from a global perspective, Krishna. Fed, BOJ, ECB. We've seen England having opposing factors at play in terms of inflation versus growth. Similarly, you could argue for the US because people who are there talk about the kind of consumerism that they haven't seen in the last 20 years being seen currently. Prices are kind of above Fed's normalcy. We might see a hike after the pause that we saw last time. What do the markets take away from the commentary as well as the actions? What is it that you're watching out for the most?
See, I think all of us have been waiting for that recession or soft landing for the last, 12 months, and that never came. So I think to that extent, somewhere now, I think the commentary shifting towards that maybe they will be able to manage a soft landing, soft landing versus a recession. So to that extent, kind of it is discount. I mean, so the markets have discounted most of it. So I think this 25 bits hike is like 90% given that maybe this week the Fed meeting, etc., there will be a Fed rate hike, 25 bits, etc. And then there may be one more, or maybe the expectations is that a soft landing has been managed, and you would see maybe rate cuts in January or onwards and all that. My take is that do I need to be aware of many of these global factors? Yes. But do I need to act on them in terms of the individual stocks that we own and manage in our active portfolios? I think sometimes no. I think we saw that in the period between Jan to March when some of the private banks in the US were collapsing, and there was a huge frenzy of FPI selling in our markets, and there was a lot of positivity as far as the US, China was concerned. I mean, that was a time when if you would have taken your faith in domestic stocks and bought into them, you would be sitting on 30 to 50% gains in many of them. So I think global factors, we do read about it, we keep on following, but then the commentary itself keeps on changing. The experts over there, they also keep on changing their comments and their expectations of going forward. And what is relevant is over there is that basically our IT companies who have massive business exposure to the US, and I didn't get, whatever I saw on a broad basis, the order inflow seems to be decent. I think maybe some small slowdown in execution, etc., is there. So that is where I would be looking at in terms of how positive it becomes for the domestic IT companies if things improve over there. That is one segment. Otherwise, for most of our stocks, I think it's better to look at the individual performances and move on.
Okay. And a final question, Krishna, your answers. Yeah, pharma, spec chem, to an extent, IT valuations, yes, but maybe the business seem to suggest that you are not as pessimistic about the global growth slowdown impact on India exporting companies' fortunes from a stock price perspective, because the negatives might be in that price. Would that be a fair assessment?
Yes, I think definitely this whole opportunity in terms of China plus one or maybe Europe plus one for domestic manufacturing companies. That is a reality. That is a reality, and we are seeing many companies benefiting out of it and also working towards this thing. So, and if you look at the number of global majors who are setting up shop in or increasing their exposure in India, and with clear-cut comments that it is not only about the domestic market, but also about the export opportunities. So there could be some headwind, etc., for maybe 3-6 months. It's fine, but from a medium-term perspective, the whole manufacturing opportunity which is there across businesses, whether it's petchem, whether it's electronic manufacturing, etc., or even defense and make in India. So I think the opportunities are phenomenal. So investors should be cognizant that when there is an euphoria or a temporary euphoria in the markets, I think your entry valuations become expensive. Just be careful on that. But from a medium term perspective, I think we are in a great time. So investors should be prepared for putting money when there are decent corrections in the market, rather than that time there will be some negative news flows here and there and get taken in by that.
Decent is 5% or 10% or more?
My sense is currently the flows have been robust. I have a feeling that maybe now we will see the SPI inflow may be kind of tapering off, and both feed into each other. When markets are doing well, the flows also are robust. When markets, for whatever reason, start, the flows also go into the reverse.
Yeah.
I think the idea is that instead of looking at a market correction, I think you should look at individual stock price corrections. And as long as you are buying into any segment, the top 3-5 companies, or micro segment or macro, whatever the way you look at it, when the corrections are setting. That's what I said in the initial stage also. I was petchem companies. Some of the majors are going through a headwind, and you buy into them. So buy individual companies. Don't worry about the market. Now, whether the corrections will be 5%, 10%, I have no answer.
Fair call. Thanks so much. No, I was just asking if 5% is reasonable or 10%. Otherwise, though, who knows? I agree completely. But
I have no answer. But I have a feeling that there is a lot of under ownership or left out feeling. So the corrections are not going to be as sharp as you would have wanted it to be.
got it. Got it. Great. Thanks so much for taking the time out.
Yeah.
Lovely talking to you. 1 year from now, I will quiz you again on the spec chem predictions, and hopefully they turn out to be truer, even faster than what you're penciling in. But thanks for talking in today.
Thank you. Thank you very much.
And viewers, thanks for tuning into this leg of the Talking Point.